My name is Andrea Madigan, and I'm an enforcement attorney with EPA Region 8. I've been working in the Superfund program for the past 25 years. In this session, we'll look at business entities and CERCLA liability. We'll talk about corporations, partnerships, joint ventures, and sole proprietorships. We'll also focus on successor liability. When you identify a company that has CERCLA liability but is no longer in business, the question then becomes, is there a successor connected to the first entity such that it in essence inherited the CERCLA liability? Business reorganizations are very common. There are mergers, acquisitions, spin-offs, and restructurings. These occur for a variety of reasons. What we're going to look at is the consequence of such activities in analyzing potential CERCLA liability. Let's start with CERCLA definitions. We know that Section 107A of CERCLA identifies 4 classes of liable persons. Persons is then defined to include a multitude of business organizations, including a firm, a corporation, an association, a partnership, a consortium, a joint venture, and a commercial entity. This is a very broad definition and includes every type of business organization I can think of. Let's turn now to identifying the most common types of business entities. First, there's the sole proprietorship. Basically, a sole proprietorship is a business owned and operated by an individual person, and there's no entity separate from the individual. For example, say I decide to start a business on the side. I clear it with the EPA ethics officer and start offering dog walking services on the weekends. I hand out cards to my neighbors and I refer to my business as Walking Matildas. I am Walking Matilda. Any debt I incur on behalf of my business is my debt, just like my personal expenses. Any income I earn has to be reported to the IRS along with my EPA salary. Just because I'm doing business under a trade name that I made up doesn't create a separate business entity. Let's talk about partnerships. Partnerships are entities where partners share in the profits and losses of the business. Partnerships are formed by contract, but no formal written agreement is necessary. Typically, there is joint administration and control of business operations. Partners are jointly and independently liable for the debts of the partnership. If I were to enlist my daughter in my dog walking business, we would become business partners. A joint venture is a short-term partnership for a limited purpose. At Superfund mining sites, I often come across joint ventures that were created to explore a particular ore body in a specific location. Each joint venture partner had other mining interests in other mining ventures that did not include the other. Limited liability partnerships are creatures of state law. They include at least one general partner that is liable for all the debts of the partnership, and limited liability partners whose liability is limited to the amount of their investment in the business enterprise. And then we get to corporations. These are legal entities created through the laws of the state of incorporation. These are the types of business entities we encounter most often in our PRP search work, and we're going to look at these in more detail in just a minute. There are also limited liability corporations, also creatures of state law. These are hybrids with characteristics of both a corporation and a partnership. These are often used by professional groups and include partial liability shields for the malpractice of others. Let's recap. A sole proprietorship is a business owned and operated by an individual, where all the assets are owned by the individual and the individual is liable for all the debts and obligations of the business. A partnership is an association of 2 or more persons to carry out a business for profit as co-owners. In a general partnership, Each partner is personally liable for all the debts and obligations of the partnership. A general partnership may be formed by written agreement or implied by law. In a limited partnership, the limited partners are investors, and their liability is limited to the amount of their investment. Limited partnerships are created under state law. A joint venture is a type of partnership that is usually limited in purpose and time. Now we're going to look at corporations. A corporation is an entity that is separate from the people that own or operate it. A corporation is owned by its shareholders. A shareholder may be an individual or a business entity. A corporation can be wholly owned by another corporation. All corporations must have common stock, and they may have one or more class of preferred stock. Profits of the corporation can be distributed to shareholders as dividends, or they can be held onto by the corporation as retained earnings. Corporations are created under state law. There's no such thing as a common law corporation. A corporation is born by the filing of articles of incorporation with the Secretary of State or similar office in the state of incorporation. Companies are free to incorporate in any state regardless of where they operate or have their headquarters. Many companies incorporate in Delaware, which is thought to have laws very favorable to corporations. Most state corporate laws are based on the Model Business Corporation Act, which was developed by the American Bar Association. While corporations are creatures of state law, federal law also plays a large role. Publicly held corporations are regulated by the Securities and Exchange Commission. In addition, corporations must comply with other federal laws that govern their activities, such as employment laws, environmental laws, intellectual property laws, to name a few. Corporations are governed by a board of directors in accordance with the Articles of Incorporation and bylaws. Directors are elected by the shareholders. Board of director meetings are usually documented with meeting minutes that record what was discussed and what actions were agreed upon. The board of directors can also create committees to carry out certain functions, and they appoint senior officers of the corporation, like the president or the chief executive officer or CEO. The corporate officers carry out the day-to-day business of the company. A publicly held corporation is one that stock is traded on a national stock exchange and is required to register with the SEC. A closely held corporation is one that stock is privately owned and not for sale to the public. Most small businesses are closely held. Now, it's not uncommon for one person to wear many hats. If I were to decide to incorporate my business, Walking Matildas, and I wanted to sell the stock to investors on a stock exchange, I would have to follow all the SEC rules to take my company public. That's a really big deal, so I would more likely form a closely held corporation where I owned all the stock. I would be the incorporator, the chairman of the board of directors, the president, the CEO, and the shareholder. It's also not uncommon for a corporation to be owned by another corporation. In that case, the parent corporation is actually the shareholder of the subsidiary corporation. We're now going to talk about corporate liability. A corporation is liable for its debts. Shareholders are not. If I own stock in General Motors, and General Motors can't pay its bills, the creditors of General Motors can't come to me as shareholder and get me to pay the debts of General Motors. I may lose the value of my stock, the amount of my investment in General Motors, but that's it. And that's a good thing considering what happened to General Motors in the financial crisis of 2007 and 2008. The primary reason for creating a corporation is to insulate shareholders from the liabilities of the corporate enterprise. This is often referred to as the corporate shield. Now, we know that there are exceptions to just about every rule, and the corporate shield is no different. Piercing the corporate veil is a legal theory used to ignore the corporate entity and to hold shareholders liable for corporate debt. This is a big deal. Just think if the creditors of General Motors were coming after you to pay for the debts that General Motors incurred but could not pay. Basically, the corporate existence is ignored to do justice. These are tough cases to make and win, and they're very, very fact-intensive. In order to be successful in a piercing the corporate veil case, the creditor must show that the corporation is the alter ego of the shareholder, that the corporate structure was used to perpetrate a fraud or defeat rightful claims, and disregarding the corporate form is necessary for an equitable result. So what kind of evidence do you need to prove up a piercing case? You need to show that the corporation has not been treated like a separate entity. This occurs where assets are commingled, where the money belonging to the corporation is used to pay the debts of the shareholder. Remember Walking Matildas, my dog walking business that I incorporated? Well, if I used my business bank account to pay my home mortgage, I could be in trouble. What I should have done is use my corporate bank account to pay myself a salary, and then use that to pay my mortgage. Otherwise, I'm not treating the corporation as a separate entity. Other factors that may support a piercing the corporate veil theory are when the parent and subsidiary corporations have common officers and directors and share a common office. This alone wouldn't be enough, but combined with other facts may support a piercing claim. Another factor would be where the subsidiary is grossly undercapitalized. That is where the subsidiary does not have enough money to carry out its business activities, such as pay for environmental compliance. Courts are going to look at the totality of the facts in evaluating the case. Under certain federal statutes, an officer or shareholder may have direct liability for actions taken on behalf of the corporation. This includes liability under CERCLA as an operator. This is very different from reaching a shareholder on a piercing the corporate veil theory. The Supreme Court in the Best Foods decision set out the parameters of this liability. The Supreme Court held that under CERCLA, a parent corporation may have direct liability if it managed, directed, or conducted operations relating to the pollution. The court, however, went on to identify some very important limitations. The involvement of the parent corporation must exceed corporate norms. Further, if an employee holds a position with both the parent and the subsidiary, there's a presumption that the employee was acting on behalf of the subsidiary. Let's take a look at an example. Walking Matildas has been wildly successful. In fact, I sell all my stock to Pets R Us, a national corporation with operations in all 50 states. They want me to stay on as president of Walking Matildas and develop franchises. They even make me a member of the Pets R Us board of directors. It later turns out that Walking Matildas engaged in some bad waste management practices and has liability for cleanup under CERCLA at a Superfund site. Can Pets R Us be held liable too? The question is going to depend upon what role Pets R Us had in those waste management decisions and what is considered the norm for the industry. If I was the one making those decisions, I would have been presumed to be acting on behalf of Walking Matildas, even though I had a seat on the Pets R Us board of directors. What corporate norms applied would likely be established through the use of expert testimony. When doing a PRP search, it will be very important to develop the corporate history for the PRPs that have been identified for a site. We've all heard about mergers and acquisitions where corporations get bought and sold and spun off and restructured. There are circumstances where a successor corporation can be held liable for the debts of its predecessor. In fact, this happens more often than you may think. What happens when a corporation undergoes change? What happens to its liability? Well, that's going to depend upon the nature and structure of the change. You've probably heard the phrase form over substance, and that is generally intended to mean that form shouldn't matter if you achieve the same result. Well, in corporate law, form matters. In fact, as we will see, the way a transaction is structured has a huge impact on liability. First, let's talk about names. When a corporation changes its name, it's the same entity. This does not have any impact on its liability. Remember, a corporation is a legal entity. Just like if I were to change my name, I'm still the same person, and I owe the same money on my credit cards. A corporation can also operate under a trade name. Think of it as a nickname. This does not have an impact on liability. A corporation can organize itself into divisions. A division is not a separate legal entity. Typically, it's an operating unit, part of the same corporation. The best place to look to figure this out is the Secretary of State's office in the state where the corporation was incorporated. If you are looking at a publicly held company, there will be information on file with the SEC. In addition, financial journals and trade journals can be a good source of information. A merger is when one corporation is absorbed into another, with the surviving corporation acquiring all the assets and all the liabilities of the other. Let me say that again. In a merger, the surviving corporation takes not only the assets, but also the liabilities of the merged corporation. When you do your PRP search and you find that the former owner or operator of a site is a corporation that no longer exists because it was merged into another company, you now have a new target. A consolidation is very similar. This is where two or more companies transfer all their assets and all their liabilities to a new corporation. The new corporation is then responsible for all the liabilities of the predecessor. In order to merge or consolidate, documents are filed with the Secretary of State in the state of incorporation. Now, an asset purchase is one where the corporation purchases all of the property of another corporation. While this may look like a merger on the outside, it is a very different type of transaction. The purchaser does not generally assume the liability of the seller. An asset purchase involves the sale of property. This is very different than acquiring the stock of the seller. Now, there are circumstances where a purchaser of assets could also have liability for the debt of the seller. There could be an express assumption of liability that was a condition of the sale. To find this information, you will need to look at the sales documents. You also may have some luck looking at the minutes from the board of directors meetings where the sale was authorized. These are not public records, and you will likely have to use information gathering authority to find them. Under certain circumstances, an asset purchase could also be construed by the courts to be a de facto merger. Even though no articles of merger were filed, the transaction will be treated as if a merger occurred. This may happen when the purchaser corporation and the seller corporation are related entities, when it's not an arm's length transaction. I've had this come up at mining sites where the parent corporation simply takes over the operation of the subsidiary, takes control of all the assets without any documentation of sale. Now, there's another theory of liability called continuity of enterprise that some courts recognize and is very similar to a de facto merger theory. This is where you have the sale of a business as an ongoing concern. The new business retains the same employees, the same supervisors, the same production facilities, the same name, and it holds itself out to be a continuation of the previous enterprise. For example, remember Walking Matildas? Let's say I'm not the best money manager. I buy only the best food for the dogs, but I can't pay for it. I sell all the assets of my business, my leashes, my bowls, my customer list, and the name Walking Matildas to a new corporation formed by my daughter. and I sell it for a nominal amount. My daughter then hires me to run the company. I've learned my lesson, and now my new business is profitable. The dog food supplier for the old Walking Matildas may have a good claim against the new company on a theory of continuity of enterprise. There's probably a fraudulent transfer in there somewhere, but that's a discussion for another day. In order to officially dissolve, a corporation must file articles of dissolution. This involves winding up the business, paying all the outstanding debt, and distributing any remaining assets to shareholders. Well, what happens if a corporation is insolvent and it can't dissolve? Or if it stops filing annual reports with the Secretary of State? It's not uncommon to find a corporation listed by the Secretary of State as administratively dissolved. This does not necessarily mean that the corporation has ceased to exist as a matter of law. It may be defunct and insolvent and not operating, but maybe it's not dead. And this could be important if assets such as insurance policies or real property continue to be owned by the corporation. In conclusion, don't assume there is no way around a corporation that no longer exists or has been administratively dissolved. Investigate facts to determine if there is successor liability. And don't overlook the liability of general partners or joint venture partners. Make sure to work closely with your site attorney on these issues. Thanks for joining me for the PRP Basic Search Training Session 6, Business Entities as PRPs. I hope you enjoyed the course. Please take a moment to fill out the evaluation form on our website and provide us some feedback on your training experience. On our site, you'll also find resources and contact information for this session.